There is a specific kind of silence that precedes a massive shift in the world of money, a quiet tension that most people mistake for stability. If you look back to the early 2020s, the small business loan was spoken about in hushed, almost desperate tones. It was the emergency glass you broke when the ship was already taking on water, a final, expensive lifeline. But as we sit here in 2026, the very gravity of the Australian financial market has shifted beneath our feet. If you are still navigating by the maps drawn 3 years ago, if you are looking at the same old charts and listening to the same tired commentary, you are missing the single largest wealth transfer mechanism currently operating in our economy. We aren't just witnessing a standard market recovery, we are standing in the middle of a credit surge, a fundamental restructuring of how capital moves from those who have it to those who know how to use it. While the evening news continues to drone on about sticky inflation and the rising cost of living, the private lending sector is orchestrating a quiet revolution. For the first time in over a decade, the chasm between the interest rates offered to massive multinational corporations and those offered to nimble small businesses has narrowed to its thinnest point on record. This is a contrarian reality that few are talking about. Historically, if you were a small operator, you were branded as risky. You paid a steep premium for the privilege of borrowing. You were the underdog. But today, the landscape has flipped. Lenders, ranging from the traditional Big Four banks to a relentless swarm of new AI-driven non-bank players, are effectively splitting the market. If you position yourself correctly, you aren't just another borrower in a long line of applicants. You become the most sought-after asset in the country. This surge didn't happen by accident. It was triggered by a specific, mandatory evolution in the Australian regulatory environment. As of July 1st, 2026, the government made same-day superannuation payments mandatory on the surface for a business with $1 million payroll. This looks like a crushing blow, an immediate requirement for an extra $120,000 in liquid working capital just to maintain compliance. To the untrained eye, this is a burden, a reason to shrink or stay small. But to the architect of their own wealth, this is the great filter. Because the government forced this liquidity requirement, they also inadvertently forced the financial taps to stay open. The credit is available because the economy literally requires it to be there to prevent a total systemic freeze-up. However, this is where the psychological divide begins. Most people treat credit like a backup plan. They wait until they are starving to ask for a meal. In 2026, that is a fatal strategy. Credit is now a product you buy, not a favor you are granted. If you wait until your cash flow is tight to apply, the AI-driven underwriting systems that now govern our financial world will sniff out that survival energy and reject your application in milliseconds. This isn't just about how to get a loan. This is about the arbitrage of confidence. It is about understanding how to use a 7.25% lending environment to fuel 30% growth in sectors that the banks are currently obsessed with. To play this game, we have to perform a fundamental brain transplant, moving away from the consumer mindset and toward the architect mindset. In Australia, we have a deep-seated, almost cultural allergy to debt. We are raised on the philosophy that the borrower is a slave to the lender. We celebrate the day a mortgage is paid off as if it were a declaration of independence. While that might be a sound strategy for a household budget, it is absolute financial suicide for a business builder in 2026. When a consumer looks at a loan, they see a cost. They see $50,000 at 7.25% as money they are losing to the bank. Their entire focus is on the interest rate. But when an architect looks at that same $50,000, they don't see an expense. They see a tool with a rental fee. If that capital allows you to purchase a piece of equipment that generates $15,000 in monthly profit, that interest rate isn't a cost, it's a rounding error. You are effectively renting the bank's money to buy yourself a printing press. This shift in identity is crucial because your business will never grow larger than your comfort level with zeros. Most Australian small business owners hit a glass ceiling because they are terrified of the liability. They stay small to stay safe. But in this new economy, safe is the most dangerous place to be. The wealthy aren't the ones with the least debt. They are the ones with the best managed debt. They understand that leverage is like fire. It can cook your food or burn your house down. The solution isn't to avoid the fire. It is to become a master chef. This requires a deep understanding of the hidden scoreboard of the Australian economy. As we move further into 2026, we find ourselves in a fascinating economic paradox. The Reserve Bank has signaled that the easing cycle is over, nudging the cash rate toward 3.85%. Ordinarily, higher rates mean tighter credit, yet the opposite is happening. This surge isn't coming from the government, it is coming from competition. For the last 2 years, the Big Four, CBA, NAB, ANZ, and Westpac have been losing significant ground in the mortgage market. With property prices plateauing, their traditional golden goose has stopped laying. To keep their shareholders happy, they've had to find a new playground: small to medium enterprise lending. They aren't just competing on rates anymore, they are competing on speed. But the real disruptors are the shadow banks, the non-bank lenders. These agile, AI-driven firms have captured nearly 20% of the SME market because they don't care about your brick-and-mortar collateral. They use domain-specific AI models to analyze your real-time cash flow and your Xero or QuickBooks data. While a traditional bank might take weeks to review tax returns from 2 years ago, a non-bank lender is offering same-day approvals based on who you are today. This creates a Goldilocks window. The economy is strong enough that customers are still spending, but the banks are desperate enough for growth that they are loosening the hoops you have to jump through. If you wait for rates to drop, the banks will stop being desperate, and the surge will have passed you by. The money is there, and the pipes are wider than they've been in a generation. But you have to know where to point the fire hose. The surge isn't a rising tide that lifts every boat equally. It is a targeted laser. To get rich in this environment, you have to be standing where the capital is already being funneled. Lenders in 2026 have moved away from broad industry codes and are now looking for sectors with structural tailwinds. Specifically, we see 3 areas where the credit surge is peaking: the green metals and AG tech pipeline, the care economy, including niche health and NDIS, and renewable energy infrastructure. These are the sectors the Australian government and global markets have effectively de-risked. If you are in a high-growth sector like cloud hosting or green tech, non-bank lenders are offering millions in unsecured lines of credit based solely on your projected revenue. This is the ultimate leverage, growing a business using the bank's money without ever putting your own house on the line. But getting rich isn't just about the industry, it's about the spread. If you take out a $250,000 business loan at 7.25%, your annual cost of carry is roughly $18,125. Your only job as an entrepreneur is to retail that capital into your business for a higher return. Whether it is through automation, arbitrage, using borrowed funds to replace expensive administrative roles with AI, or equipment arbitrage to unlock capacity, or even acquisition arbitrage by buying a competitor at a low multiple and revaluing it within your larger entity. The logic remains the same. If you refuse to borrow at 7% to fund a 30% return project, you are losing 23% every single year in opportunity cost. However, to play this game at a high level in 2026, you must protect your identity. The Australian Tax Office and the banks have more visibility into your life than ever before. To truly profit from this surge, your personal identity and your business entity must never share a heartbeat. You need the iron wall strategy, a corporate trustee model to protect personal assets, a rigorous audit of any personal guarantees, and a relentless commitment to compliance to shield yourself from director penalty notices. When you remove the fear of personal ruin, you actually become a better entrepreneur. You take bolder, more logical risks because you know your foundation is poured in concrete, not sand. Finally, you must learn to speak the language of the algorithm. The traditional bank manager who played golf with your accountant has been replaced by an autonomous credit agent. In 2026, lending is no longer a snapshot of your past. It's a live stream of your present. To get an unconditional approval in hours, your digital footprint needs to reflect operational excellence. This means daily reconciliation in your accounting software, optimizing your transaction keywords to signal growth rather than survival, and maintaining a super buffer to show you are ahead of the mandatory payday laws. The most successful operators in 2026 are not applying to their own banks out of loyalty. They are using the shadow application process, running their data through AI aggregators first to see which lender's algorithm is currently hungry for their specific risk profile. They understand that in this credit surge, capital is no longer a reward for hard work. It is the fuel for strategic vision. The gates are open, the liquidity is flowing, and for those who have performed the brain transplant from consumer to architect, the path to massive wealth has never been more clearly illuminated. The only question left is whether you will treat this moment as a burden to be avoided or as the greatest arbitrage opportunity of your lifetime.